Well, welcome back to Finance Uncut. On today's episode, gold and silver to the moon. A big shout out to Tavi Costa. A lot of the charts in this video we use from his latest newsletter. And I'll put a link in the description below so that you guys can sign up to his newsletter. I highly recommend it. The only difference between these two notes is your belief that one has more value than the other. And when we have a look at this chart of average CPI since 91 to 2021, so 30 years, it's 2.29%. And central bankers will tell you that's beautiful. That's a beautiful CPI rate for the economy. But cumulatively, that works out to be a 97% CPI rate, inflation rate. So what that means is if you're a saver, if you're a retiree and you saved currency, saved dollars, then you're getting poorer and poorer every year. $197 worth of goods or purchasing power in 91 buys you about $100 now. So you need more currency today than you did back in 1991 just to buy the same goods and services. And ECB's Panetta says that EU mustn't revert to pre-crisis economic norm. So the ECB and the EU are pushing for just crazy MMT. I mean, they're making the Fed kind of look quite conservative and quite responsible. So once again, look at what central banks do, not what they say. Inflation is back near targets, and that should be celebrated, says the central bank group, the Bank for International Settlements. I mean, these people are nuts. These central bankers are nuts. Their policies of inflation, currency printing, devaluing, debasing the currency is hurting the poor and the middle class. It is their policies that are creating such gaps in the wealth inequality and such anger amongst society that they are idiots. They're either idiots or they're actually evil so-and-sos. I'm not going to swear. So a lot of people are talking about inflation being transitory and that lumber has come off from its highs. By the way, if you track lumber from its lows to where it is today, it's still significant inflation. It's just lumber absolutely skyrocketed. So even though it's come back, it's still up significantly from its lows. But steel futures, they're still going vertical. It's not like we use steel in many of our many of the things that we use each day, right? So the other debate is, and once again, Jim Rickards goes on about this before, and I've shared in other videos. I've used data to prove that money velocity is overrated. Now, it's not to be dismissed, but it is not the be-all and end-all, because I've shared we had low velocity in the 70s, yet we had high CPI. We had high velocity in the 90s, yet we had low CPI. And our currency velocity today, the rate today in the US, is exactly the same as it was in 1945-46 when we had CPI at, 19%. So I've used data and evidence, empirical evidence, if you want to call it that is wrong. And if we have a look at Japan, their velocity and gold in Japanese yen, gold has done well. Gold is up 357%, while Japan's currency velocity has fallen. So, this whole you need velocity to create inflation because velocity is going down. You don't have inflation. Well, first of all, you got the wrong definition of inflation to begin with. You get the right definition of inflation. So Brazil and Turkey, their M2 currency velocity has also been tanking. So, hopefully someone sends this video to Jim Rickards and, watches some of my other videos as well. Because what's Brazil and Turkey's CPI? Well, according to Professor Steve Henke, and I recommend that you guys follow Professor Henke, he's got Turkey's annual inflation as of the 30th of June at 33.84%. So we've got velocity going down, yet CPI going up. Well, what about Brazil? Well, according to Professor Henke, 26.11%. Well, how can that be? Velocity is going down. Don't be fooled, friends. Don't be fooled. So in an environment of rising inflation, where most financial assets are at record valuations and yield less than inflation expectations, commodities and natural resource stocks offer strong value properties and near-term high-growth tailwinds, in my opinion. So we've got negative real rates. I don't understand why anyone would hold bonds at the moment. But commodities on a value proposition, I think commodities, natural resources, the massive tailwind for growth. And the case for gold and silver miners remains incredibly strong. We have triple-digit free cash flow growth, insanely cheap valuation, strong balance sheet, profitability on the rise, and on top of it, they are now looking historically oversold. So, when we look at the RSI, you can see that it looks quite oversold, and each time the RSI has been this low, silver has gone, or gold and silver, miners have gone on a really nice run. And when you look at the 3-week there, look, same thing. So, look, gold and silver stocks, they're on track now to report the 6th straight profitable quarter for the first time in history. So the median free cash flow yield is now at its highest level in 26 years. So they're cheap. The fundamentals are behind it. They're producing free cash flow. They've got the least amount of debt they've ever held. It just adds up. It's like 1 + 1 = 2. To me, it just makes sense. And from a macro perspective, it all comes down to this chart, I believe. So I think it's prudent to be long commodities paired with short positions in the most overvalued parts. And I think I've shared in other videos that I have identified some stocks. So in March last year, when the market crashed, my business partner and I, we started shorting the market. And we made, in 2.5 weeks, we made a 780% gain on those short positions. And we have identified stocks again that we want to short when the market is about to tank again. We don't want to get in too early, but so that's how we're playing this. So yes, we're sitting in US dollars. We've got some US dollars as part of our portfolio. We're heavily invested in the gold and silver space and the mining space and the physical space and other commodities as well, which I'll come to shortly. But as well, we've got some cash sitting there, both in US dollar terms and Aussie dollar terms, to put to use shorting the market. And we've identified these stocks that we believe will do well in that environment. So when you look at the RSI and Bollinger Band combo, to me, it looks like the short-term lows have hit in gold. So, once again, you look at silver, look at gold, look at the gold-silver miners. The technical, to me, looks like the bottom's in. So these are all bullish, I believe, for gold and silver. And once again, end of the quarter, silver remains well consolidated at these key resistance levels. It's really done well, to be honest. And we had in the middle of June, both gold and silver absolutely smashed down. And I'm doing a little bit, excuse me, I'm doing a little bit of investigation at the moment because I've got a Basel III video coming up, an update video, and I'm just doing a little bit of research at the moment because I think that could be connected to Basel III. That it was around the 16th and 17th from memory of June, where gold and silver was smashed down. But anyway, I'm not going to go into that right now. I'll save that for my Basel III update video, which, I'm putting quite a bit of research into that one, so you might want to check that one out when that comes out, which should be maybe next week. But also the thing, I was trying to find a chart. Unfortunately, it was from our mate at CPM Group, but it actually shows that June, July is usually the worst worst months for silver in terms of its price. So it also didn't surprise me, and I've said this previously to people that I didn't expect June and July to be very good for silver, and that's certainly been the case. But look, based on this, I think once it breaks out, I think it definitely can get back towards its highs. Personally, my price target for the end of this year on silver is, I think $32 is not. I think that's being quite conservative, but there's a few things around the whole Basel III thing which is quite interesting to me, and I really wanted to share some of the data that I've already researched in this video because it really backs up where I think gold and silver is going, but I had to hold that back for the Basel III update video. So anyway, frustrating. And also when we look at silver versus the equal weighted commodities index, this once again, this chart right here is bullish for silver. Absolutely no doubt, this is bullish for silver. So silver's going much higher, gold's going much higher. The only question is, what's the timeline, the date, and that's the difficult thing for us precious metals investors, is getting or understanding that time frame. And if you're a trader, that's obviously much more trickier. But as an investor, we don't care. You sit this thing and ride it, and buy on those pullbacks. Buy when it gets smashed down. I went and bought some more coins. My business partner bought some more silver when silver was smashed down last month. Now, when we have a look at central banks, so this is China, their precious metals assets. So have a look since the GFC. This is both gold and silver. Look at what they've been buying. We know other central banks, and I've got a video coming out on this, but central banks are buying gold in particular like no tomorrow. And we know Russia now holds more gold than US treasuries. And when we look at Chinese silver imports, they've been quite strong for the last several years. Now, this chart, this is a little bit in my, I'll touch more on this in my Basel III update video, but, we knew that gold was a safe asset long before Basel III changed it to a tier one asset. We also knew, like many other sophisticated investors, that non-yielding physical gold was far superior than negative yielding sovereign bonds, as Jim Grant calls it, return-free risk. But this is the central banks, and even them, they can't deny this, that they've been purchasing more gold than treasuries. Full stop. I keep saying this. Look at what central banks do, not what they say. They are buying gold. Why are they buying gold? Well, this is where I'm starting to do some research and dig deep, and I'll share some of that in my Basel III update video. I love this chart from Mike Maloney, goldsilver.com. Look at the amount of currency creation, and look at the creation or the production of gold, and then the production of silver. You can't tell me this ain't bullish for gold and especially silver. Silver price predictions for 2021. What's interesting is metals focus. They are saying well above 30, and I believe they've got the interesting thing about them from memory is they've actually got access to a lot of the data. Is it from the LBMA or COMEX or anyway? They've got a lot of inside data. Okay, everyone says that Jeff Christian and CPM Group have got all this inside data and that. No. Metals focus does, and they're saying exclamation marks there. Well above $30. So that's the silver price predictions for this year. So you can see Citi is 40, Goldman Sachs 40. That's interesting. I did have 40 as my price target earlier this year for silver in 2021. Mine's probably more in the Sprott range now, around the $32, $34 mark is my price target. Some of these other ones that are $23, $27, look at JP Morgan, $26.50. So basically think it's, him and Jeff Christian, $28.17. Average. I guess that's average. So, over the whole year. But yeah, I think have a look at metals focus, Sprott, well above $30. So take that into account, and yeah. So I'll put a link in the description to this article from Seeking Alpha. 3 reasons why it is time to buy gold, silver, and miners hand over fist. Fantastic article. You know what? I got to be honest. Silver and gold and the mining and exploration space has been beaten down, and I've just looked at the macro outlook once again. I've re-looked at my thesis, and I am even more convinced that I am right. And I am now doubling up my efforts, and I am literally buying gold, silver, gold and silver miners and exploration companies, and some other commodity stocks as well, hand over fist. And in this article, I'll put a link in the description as well. Higher inflation for the next 5 years, be overweight stocks, gold, and commodities, says Wisdom Tree's research head. In the article, it says, if inflation is much higher than people expect, that's where you start to look for other diversifiers. And that's where we think things like commodities could have a big role. Wisdom Tree's recommendation is to move away from bonds and embrace an overweight position in stocks, gold, and other commodities. Well, that's what I've been pretty much saying this since I started this channel. We don't think it's going to be a taper tantrum like before, but market tremors along with volatility are something to watch. We do like things like the industrial metals as well in the sense that we think there's some longer term shift to EV battery type energy, and some of the industrial metals from copper and nickel benefit from that. And absolutely, and 2 of my largest positions in the exploration space are actually in the copper and nickel sector. Very, very exciting explorers I've got. My copper explorer, since I bought it, is up over 300%. I shan't be, as Aussie slang goes, selling that one anytime soon. That one is red hot. And my nickel holding, I might talk about that one in a future video, because that's very exciting. Yet it hasn't really moved much from when I bought it, so I'm definitely doubling up my position in that stock. And I'll talk a little bit more about this once again in my Basel III update. But Basel III to trigger liquidity squeeze, gold price could be looking at 2100 by year end. And that's the end of this year. Remember, it's only some European banks that currently have to abide by the Basel III rules, even though most of the European banks shut down their precious metals trading desks. The LBMA and the bullion banks don't. They're not under the Basel III rules until January 1, 2022. So the real price rises in gold and silver for mine won't happen until next year. In saying that, I think this is a great opportunity to get in. And Wall Street smart money is accumulating physical silver ahead of new Basel III regulations and price explosion to $44 an ounce. Chris Vermeulen, and I'll put a link in the description of this as well. And I'll talk more about this, as I said, in my Basel III update video. But anyway, guys, what do you guys think? I think gold and silver, both the physical and the miners, have just been absolutely smashed. They are the most undervalued asset on the planet out of any asset class, in my opinion, not financial advice. And my macro theme or thesis is a decade of inflation, and significant inflation and CPI increases over the next couple of years. With Basel III, everything else, I mean, just the tailwinds for this is just unbelievable. You know, where there's headwinds for property, there's headwinds for the stock market, there's headwinds for the bond market. They're in such big bubbles. The only thing that's not in a bubble is gold and silver miners and explorers. It just, in my opinion, it makes sense. What do you guys think? What do you guys think? Don't forget to hit that like button, guys. If you like this video, I really do appreciate getting those thumbs up. It really does help the video. But love to see your thoughts and opinions in the comments below. Take care, everyone, and I'll see you again on another episode of Finance Uncut.